The silence was the most deafening part. For 10 full years, the entire financial world agreed on one single unshakable truth. Silver could not break $30. It was the most stubborn ceiling in all of commodities. Every rally, every glimmer of hope in 2016 and 2020 and 2021 was met with a ruthless mechanical sell-off the moment it touched that magical number. The market's memory was etched in pain, and the algorithm was simple: sell at 30. This wasn't just a price level, it was a psychological prison, a monument to failed breakouts and surrendered gains. It bred a generation of investors who saw silver as a relic, a volatile toy for fringe thinkers, forever trapped, while everything from tech stocks to cryptocurrencies made history. Then, 2025 happened. It didn't break the ceiling, it detonated it. A 144% annual gain is not a rally. It is a geological event in market terms. It is the sound of a dam bursting. That vertical line on the chart, climbing from the low 20s to over $50, represents more than money. It represents the violent shattering of a decade-long consensus. Every short seller who leaned against that $30 wall, every fund manager who dismissed the metal, every algorithm programmed to short the resistance, was instantly, catastrophically wrong. The gain itself is the signal. A flare shot into the financial night announcing that every rule from the past decade is now obsolete. The prison door isn't just open, the entire building has been reduced to rubble. But here is the critical, terrifying fork in the road that this signal reveals. History provides the map, and it shows only two destinations after a move of this magnitude. There is no middle ground. We have seen this movie before. In 1979, silver began a parabolic run that would become legendary. In 2010, 2011, it surged over 100% in a year. The aftermath of these explosions is binary. The first path is a total, catastrophic collapse, a complete mean reversion that erases the entire gain, and then some, a brutal 70% plunge that liquidates euphoria and returns the asset to obscurity. This is the path of a short squeeze that exhausts itself, a speculative fever that breaks. The other path is the continuation of the parabola. It is the second, third, and fourth wave of buying, where the initial breakout is revealed to be merely the opening act. This is where assets become legendary, where gains are measured not in percentages, but in multiples. This is the 1979-1980 moonshot, where silver didn't just rise, it ascended to heights that seemed mathematically impossible. We now stand at that precise fork. The 144% gain of 2025 has fired the starting pistol. 2026 is the year we discover which path we are on. And every fundamental piece of data, every physical ledger, every supply chain ticket is screaming that we are not on the path to collapse. We have already boarded the parabola. The reason is simple and undeniable. The physics of the market have overwhelmed its psychology. For 5 consecutive years, a full half-decade, the global silver market has been in a structural physical deficit. More silver has been consumed by industry and investment than has been mined and recycled. This isn't a paper trade. This is the reality of vaults emptying. These deficits were quietly papered over for years by drawing down above-ground stockpiles, the leftover buffers from a previous era. But you cannot drain a reservoir forever. The 2025 breakout was the market's first loud acknowledgement that the buffer is critical, that the just-in-time physical delivery system is cracking under the strain. This is not a speculative frenzy in a vacuum. It is a price discovery finally catching up to a physical scarcity that has been building like tectonic pressure. The deficit is the engine, and the 144% gain was the first major tremor. A short squeeze can reverse, a true physical shortage cannot. It must be solved by either a massive sustained increase in price that destroys demand, or a total systemic failure in delivery. There is no third option. Now, layer onto this physical shortage the most powerful demand story in generations, the artificial intelligence revolution. This is the new variable that makes this cycle different from 2011 or even 1980. Silver is no longer just a monetary metal or a simple industrial commodity. It has become a critical, non-substitutable input for the defining technological shift of our age. AI requires silicon, but silicon requires silver. The advanced 3 nanometer and 2 nanometer chip packaging that allows for NVIDIA GPUs to function is utterly dependent on silver's unique conductive properties. The liquid cooling systems required to stop these monstrous server racks from melting rely on silver and peerless thermal conductivity. This is a demand driver with the fiscal might of every tech giant on Earth behind it. And it is slamming into a supply chain that was already struggling to keep up with solar panels and traditional electronics. The AI narrative turns silver from a cyclical commodity into a strategic material. It provides a floor of demand that did not exist in previous parabolas. It means that even if some investment fever cools, the industrial bid is now structural, deep, and growing exponentially. This fundamentally alters the historical playbook and tilts the scales violently toward the parabolic path. Simultaneously, the monetary landscape is performing a perfect synchrony with this industrial story. Central banks, led by China, India, and Singapore, have been net buyers of gold for over 2 years straight, a relentless accumulation that has propped up the entire precious metals complex. Gold is the anchor, the deep sea buoy that silver is tethered to. As gold moves higher, it pulls silver's potential ceiling with it. But silver, with its smaller market and higher volatility, doesn't just follow, it amplifies. The gold to silver ratio, which spent years languishing above 80, has now compressed violently. As gold holds strong or advances, the room for silver to explode in a catch-up trade is immense. This is the history in reverse part. We are not in the Volcker era of high rates crushing metals. We are in a world of peaking, then potentially falling, real interest rates, of staggering sovereign debt, and of a palpable loss of faith in pure fiat constructs. This environment doesn't just tolerate a rising silver price, it invites it. It is the fertile ground for the parabola to grow. This brings us to the forecasts that are now crossing from the fringe to the mainstream. Analysts like Hibbard, who have monitored these flows for decades, are now publicly discussing targets like $175 an ounce for this cycle. This is not a random number. It is a mathematical projection based on the scale of the physical deficit, the compression of the gold to silver ratio, and the sheer momentum unleashed by the 144% breakout. These targets are a recognition that in a parabolic move, price discovery becomes nonlinear. It is not about steady 10% gains. It is about weekly, sometimes daily, upward repricing that leaves the market breathless. And this is where that once laughable Bank of America $309 silver alert re-enters the conversation. It is no longer a joke or a conspiracy theory. It is a stark representation of a potential end state. If the current deficit, multiplied by AI demand and supercharged by monetary debasement, leads to a true physical delivery failure on the COMEX or LBMA, the price will not be discovered in an orderly fashion. It will be discovered in a panic. The $309 figure symbolizes a market where the paper price and the physical price, already diverging as seen in record-high retail premiums, completely sever their relationship. It represents a repricing of the entire global stockpile of above-ground silver based on strategic, not merely industrial value. Therefore, 2026 is not merely a sequel to 2025. It is the climax. The 144% signal was the wake-up call. The consecutive annual deficits are the fuel. The AI bottleneck and the shifting monetary world are the accelerants. We are now in the phase where sentiment chases price higher, where fear of missing out overwhelms the fear of volatility. This is when the public, the final marginal buyer, enters the fray, looking at a chart that has already gone vertical and deciding it must go higher still. This is the parabola. It is beautiful and terrifying in its simplicity. It is the point where logic suspends and momentum takes the wheel. The warning for any investor is this: parabolic moves do not end with a gentle peak and a slow decline. They end with a sharp, violent reversal, a blow-off top. But between here and that end, fortunes can be made and lost. The opportunity is in recognizing you're in the parabola early enough to participate with disciplined risk. The peril is in believing you can time its end. The 144% signal has flashed. History, armed with entirely new weapons, is now playing in reverse. The decade of suppression is over. The era of volatility, and potentially of historic price discovery, has begun.